Ladies and gentlemen, thank you for holding and welcome to the BWP Trust 2021 full year's results briefing. Your lines will be muted during the briefing. However, you will have an opportunity to ask questions immediately afterwards, and instructions will be provided on how to do this at that time. I would now like to hand the call over to the Managing Director of BWP Trust, Mr. Michael Richwood.
Good morning, everyone, and thanks for dialing into our full year results teleconference. As you be aware, we've released to the ASX this morning our full year results announcement, our 2021 annual report, and the presentation slides, which we'll go through now before we take questions. The slides are also up on our website if you need to access them from there. Andrew Ross, our Head of Property, and David Hawkins, our Finance Manager, are also on the call from Perth and will be available to answer any specific questions at the end of the presentation. We'll go straight to slide 5, which summarises the full year outcomes. You'll see on that slide that revenue for the year ended 30th of June 2021 was 152 million, which was down marginally from the prior year. Revenue in the year prior included a couple of one-off impact deposit payments which had been forfeited by prospective buyers of 2 BWP-owned properties, and that resulted in a higher revenue in that year. COVID-19 related shutdowns, trading restrictions and border closures continued to impact various sectors in the Australian economy during the year. The Trust was well positioned with a significant majority of our rental income exposure to Bunnings and other national large format retailers. Most of our retailers generally traded pretty strongly throughout the year, and the impacts were a lot less significant than for others. The Trust collected almost 100% of its rent for the 12 months, and that was after accounting for approximately $473,000 of rent abatements that were provided during the year. There was portfolio rental growth during the period from scheduled increases and from additional rent from completed developments, and this offset some of the loss of rent due to some stores that are in the process of being repositioned at the moment, also the rent abatements, and the fact that we're also cycling against the reducing impact of straight lining of rent, which was an accounting standard that we had to adopt a couple of years ago. The distributable profit for the year was $117.4 million, and that was the same for the prior year. That included $3.5 million of capital profits, and as we've in the last couple of years, we are using a bit of capital profit to support our distribution when there's timing differences in terms of vacancies and repositionings, which we are going through a bit of that in the portfolio at the moment. The full year distribution was 18.29 cents, and that was in line with the prior year. NTA increased about 3% in the last 6 months and 7.5% for the year, and that was just driven by the increases in value of the number of properties in the portfolio, and that's been driven in part by rental growth and also by cap rate compression. We'll talk a bit more about that in a moment. The Trust's property portfolio generated 1.6% like-for-like rental growth on an annualised basis, and that took into account for those CPI leases in the portfolio. The CPI for the year was 0.5%, so that at the moment is having a bit of an impact on that like-for-like growth. The portfolio cap rate reduced to 5.65% at 30th of June, and that was from 5.84% at the 31st of December and from 6.08% at the 30th of June 2020. And that was the result of portfolio revaluation uplift of almost $150 million for the year. there were, I mean, as we said at the half year, through the year, there's been a number of transactions, Bunnings Warehouse property transactions, particularly in the first half of the year, and pretty much all of those properties were trading at cap rates well below 5%, and that has continued to provide very strong market support for valuations, and that's why you're seeing that reflected in the increases in values. Portfolio WALE at the 30th of June 2021 was 4.2 years, and that was similar to that reported at the half year and slightly higher than that reported for 30th of June 2020. Bunnings exercised options on 10 properties during the year. At 30th of June, there's 74 properties in the portfolio and with about 98% occupancy. Gearing was about 18%, with cost of debt a little bit over 3%. If we go to slide 6, just in terms of climate risk and sustainability actions, we have done quite a bit of work during the year to improve our understanding of the potential impact of climate risk in our business, and also to quantify and further reduce carbon emissions. We had an independent review undertaken of our methodology for calculating carbon emissions, which took into account our structure and also the nature of the leases in place in our properties. The carbon emissions that are the responsibility of the trust are limited to common areas at some of our multi-tenanted properties. Lessees are generally responsible for the emissions in relation to energy use at the significant majority of our properties. And most of the emissions from electricity usage relate to Bunnings. Bunnings is separately targeting net zero Scope 1 and 2 emissions by 2030. The Trust generated operational carbon emissions of 177 tonnes for the year. We actually avoided carbon emissions well in excess of that amount from solar energy generation across the portfolio. We're continuing to invest in solar and LED lighting to further reduce our emissions. We're also in the process of purchasing Australian carbon credit units to offset that residual 177 tonnes, and we'll continue to do that until such time as we've completely offset the carbon in the portfolio. During the year, solar was installed at a further 3 properties, and that brings, at the moment, the total number of properties in the portfolio with solar to 23. 96% of the properties in the portfolio have LED lighting installed in all or at least some areas of the property. We're also progressing towards finalising the implementation of Task Force of Climate-related financial disclosure recommendations. During the year, we completed the climate scenario analysis, which assumed 2 and 4 degree temperature changes and the potential impacts of that. At this point in time, the outcome of that analysis was that neither of those scenarios are currently considered a material business risk for BWP on the basis of assumptions applied, and I guess that's something that you have to keep revisiting as time goes on. If we then go to slide, well, I won't talk to these slides, but we've shown on slide 8, 9 and 10 a summary of our financial performance on a 6-monthly, yearly and 5-year basis. The one thing I will note, we at the half year we'd agreed with the board a management fee waiver on $75 million of assets, and that was for a 6-month period to the 30th of June 2021. The board has extended that waiver to the 31st of December 2021, and it will continue to be reviewed on a half-yearly basis thereafter. If we go to slide 12, we show on that slide the outcomes of 13 market rent reviews finalised during the year. Overall, as you can see, the outcome was flat. As advised at the half year, there was a 13% reduction in the rent at Albany in Western Australia, which had been arrived at by third-party determination. As you may recall, Albany is a regional store, and in that particular case, the comparable market evidence was at a lower rent, and that rent, or that evidence, was used by the determining value in assessing the rent on our property. As you can see from the chart, for some properties the rent didn't change, and there were other positive and negative outcomes. When we've talked about it before, in terms of how that process works, that each property, you have to look at the relevant market evidence to that property, and that's why you get different outcomes on an individual property basis. And the way we look at it is on an individual property basis. That being said, we have said for a little while that we think broadly the portfolio is at about market, and I guess these most recent market rent reviews support that view. We do have a number of other market rent reviews, which we are in the process of finalising at the moment. On slide 13, we just show the makeup of the rent reviews for the year. And as I just said then, there are a number of market rent reviews still in process, and we expect a number of those to be resolved this year. On slide 14, we just provide a little bit of detail on our like-for-like rental growth calculation. And as I said in the summary, for the year it was 1.6%, and that took into account CPI of 0.5% for the portfolio. On slide 15, as we normally do, we show a slide of the cap rate trends for the sale of Bunnings Warehouse properties over time, and as you can see, that trend is continuing to trend downwards. The most recent sale was on a cap rate of 4.2%, and that was a property outside or between Toowoomba and Brisbane, a bit of a smaller property, so it was slightly lower capital value than some, but it still attracted a very strong, it attracted a number of bids, and it achieved a very good outcome. And the most recent sale of an existing third-party owned Bunnings Warehouse property at where it was on a cap rate of 4.5%. So generally, cap rates are still remaining very strong for Bunnings Warehouse properties. Slide 16, we provide a bit of information there on our portfolio revaluations, and I mentioned that cap rate compression in the summary at the start. For this 6 months, there were 8 independent valuations and 66 directors' valuations. Cap rates on 24 properties tightened, 42 remained the same, and cap rates on 8 properties increased. And generally, particularly in this market, if cap rates are increasing, it's in some cases because it's getting to the end of a term, and for other cases it may be properties that Bunnings has indicated that it's going to move out of. On slide 17, we show the results of those independent valuations during the period. As you can see cap rates for Wallsend, Gladstone and Southport and Bayswater were tightened in line with market conditions, and the cap rate for Joondalup, which is now a non-Bunnings property, increased slightly, and that reflects a shorter term remaining on the lease on that property at the moment. If we go to slide 19, we just provide a summary of the metrics for our core properties in our portfolio. And if we go to slide 20, we just show the weighted average lease expiry profile of the core portfolio, and you can see from that it's not until FY 2026 that there's a number of properties that get to the end of their current lease term, and that, as we've explained previously, lines up with previous portfolio acquisitions, so that's why you end up with, in a particular year, more properties that are reaching the end of their current term. On slide 21, we just show, as we've done previously, expiries for the next 3 years, and on that list, the only property that we're aware of currently that is at risk of Bunnings moving is Harvey Bay. There's actually, and I think we mentioned this at the half year, that Bunnings have a site next door to the existing property, and we understand they're looking to build a new store on that. So we have started a leasing campaign and looking to redevelop our property for large format retail, and that's on the basis that if Bunnings does actually move at the end of this term. Our property is a pretty well located property in Harvey Bay. It's right next to the Stockland shopping centre on the main road, and it's on the higher side of the road, so there's great visibility and good access. So we would, in the event that Bunnings does move, we'd expect to be able to achieve a fairly good outcome on that property. In terms of the rest, we're certainly not aware of anything at the moment. On slide 22, we've completed an upgrade of our Croydon store in Melbourne. We've just provided a summary of what that means. And importantly, our valuation uplift on that property at 30th of June was well in excess of the cost of our upgrade, so that's a good outcome. And similarly, on slide 23, we've just shown a summary of the outcome of the upgrade of the Port Melbourne store, and again, that's had a good valuation uplift at 30th of June as well. On slide 25, we have talked about Underwood previously, that we were in the process of selling that sale completed during the half, and we've just shown there some metrics of the performance of that property while it was a Bunnings warehouse, and it certainly generated great returns for BWP. I mean, we looked at a number of redevelopment options for that property, but in the end thought that divestment was the best outcome, so that's why we proceeded down that path. And on slide slide 26, we've also shown the outcome for our Mindarie property, which we actually settled on the 30th of July after year end. But similarly, in the period of that was leased to Bunnings, that property generated a very good return for BWP. We did go through a rezoning of that property and looked at various development options for ourselves, but again, in that particular case, we opted to go down the divestment path. On slide 28, we've just given a summary of the other properties in the portfolio that are going through or are likely to go through some sort of redevelopment over the next few years. I should just note that we've now got two development managers in our team. One has been with us, both employed during various stages of COVID, and both based in Melbourne, but one's been with us for a bit over a year and previously had 10 years experience at Aventus, and the other one who recently joined us has had a number of years experience with Aldi and also some time with Coles. So it's great to have them both on the team, and certainly some of the properties that we're looking for options for over the next few years will certainly benefit from that increased development experience. Just going through that list briefly, Cairns, we've actually entered into a non-binding lease agreement to lease the building as a film studio, and we're just in the process of finalising leasing arrangements on that. We're actually quite happy with that outcome, and hopefully it's going to be an employment generator for Cairns. It is to a good covenant, and we'll certainly talk a bit more about it once the lease is in place. And also because it's a whole building lease, so we're not required to spend any capex on it, but it does leave surplus land for us in the front end behind the building, which is not needed for that purpose. So we are looking at redevelopment options for both of those areas, and particularly on the front, it's likely to be some sort of large format retail. So, ultimately, if that redevelopment also goes ahead, the overall returns on that could be quite attractive. I think, given that it's taken a while to find the right outcome. Morley in Perth, we're working through a leasing campaign on that property at the moment, and it's probably likely that the current best use for that property is, and particularly given its location, is lifestyle leisure, and we are receiving quite a bit of interest in the property in that regard. As it's indicated before, there is pretty attractive zoning on that property, and it's why we want to keep it in the portfolio. But the work that we've done previously indicates that from a higher and better use perspective, it's probably a bit longer term. So, our focus is at the moment is on a sort of short to medium term outcome with a potential better longer term outcome. Belmont North, we've actually just entered into an arrangement with the New South Wales government, state government, to turn Belmont North into a vaccination centre for COVID for a period of up to 2 years, and that's up and operating now. At the same time, we've just received approval for the rezoning of that property, which does broaden the potential uses at that location. So we're working alongside, and during that time while it's been used as a vaccination centre, we're also working up what will be the best outcome for that property longer term. to position that property for large format retail, and we are actually getting some fairly good interest in that at the moment. So we're pleased with how that's progressing. Midland is still leased to Bunnings. Bunnings moved out in December last year, but so it's leased to Bunnings until September this year. We have entered into a lease with a car dealership to just take over the property again. It's a lease where we don't need to spend any capital. We've just taken the property as is, and again we're viewing that property as a very well located property, and so we're taking a short to medium term outcome, but also looking at the longer term in terms of what the longer term use of that property might be. Harvey Bay I've already spoken about. Albany, as you can see from the slide, that's still leased to Bunnings until October 2024, so we're still working through what the best outcome for that property is. Same with Northland, that's leased to Bunnings until August 2025, and we're, given the location of that property, we're certainly looking at longer term uses for that property, which might include rezoning. It's a very, very well located property and a very sought after area, so that's certainly a property that we want to keep in the portfolio and want to find the best longer term use for. Wagga is the last property on that list. It's leased to Bunnings till March 26, and Bunnings is obviously still operating from the store. We are aware that Bunnings is seeking to get a DA on another property in Wagga, but as far as we know, they don't have that DA at the moment. Our property is in a strong commercial precinct in Wagga, so while we've got a bit of time on that property, we are again working on what is the best use of that property in the longer term in the event that Bunnings doesn't move on. Turning to slide 30, we just provide an update on our debt facilities. We did issue a new 7-year bond in March. We've also extended our CBA and Westpac facilities for a further year each. And we've also restructured, we had a 5-year facility in place which was drawn down with SMBC. We've restructured that facility, so it's now a 5-year forward start facility which is not yet drawn down, and at the moment we've got a bond maturing in May next year, so we will use that SMBC restructured facility to repay that bond in May next year. Well, certainly that's our position on that at the moment, unless something else changes that down the track. Slide 31, we just show a graph of debt duration. You can see it's fairly well spread, and that profile is on the basis of what I just said about the SMBC facility repaying the bond from next year. On slide 32, we just show what's left of our hedging. I mean, currently we're well hedged, and our bond issues are fixed rate bonds, so we don't need any swaps in place at the moment, and so that's why our hedging looks like it does for the moment. If I now turn to slide 34, which is the last slide, and just in terms of outlook, look, from an operating point of view, we remain pretty well positioned with most of our income obviously coming from Bunnings and from other national large format retailers, all have been trading well over the last year and are continuing to trade well. I mean, as I said at the start, our impact to date from COVID has been relatively minor, and while you can't know for certain what's going to happen with COVID, certainly, we expect something similar this year unless things changed significantly from what we can see at the moment. Demand for Bunnings warehouse properties has continued to be strong during the year. We haven't seen any change in that investor attraction to Bunnings warehouse properties. So, particularly in this interest rate environment, and particularly given the Bunnings covenant, so we're not expecting much change there at this stage. We just show also on that slide rent reviews coming up over the next year, or this financial year. In terms of our focus, I mean, we do have some properties that we're working through in terms of repositioning at the moment, so that is a focus, or that is a major focus for us because it does have an impact. So we're putting quite a bit of effort into that. We're likely to have some other store upgrades which will also progress, and obviously continuing to work with Bunnings on any other potential store upgrades, and also on extending leases and exercising options where it's relevant. We're also continuing to be pretty active in terms of looking for assets. We did bid on a few during this last financial year. We certainly bid at prices that we thought were pretty aggressive. The market was obviously slightly more aggressive than we were, and so we haven't been able to add any properties to portfolio. We'll obviously continue to do that. You do go through periods of time when good properties come up and when others come up that are not so attractive. Certainly in the last 6 months there have been a few that have come up which we've thought would have been really good assets for our portfolio. So it remains to be seen what will come up over this next year. In terms of distribution, and I guess this is subject to there being no sort of major COVID or other disruption over the current financial year, but we expect our distribution for the year ending 30th June 2022 to be similar to the ordinary distribution paid for the year ended 30th June 2021, and as we've done in the last year, if required, we may utilise some capital profit to support that distribution if it's necessary. And what drives that is timing. It's timing on, because we pay out 100% distribution. It's timing on when vacancies get filled, and also when vacancies occur in the portfolio, or at a time when we think the best outcome is the best property. So that's why that occurs. Look, that's a summary of the outcomes for the year and the year ahead. So I'll hand back to the call organiser and then take some questions.
Thank you. We will now begin the question and answer session. If you wish to ask a question, please press star 1 on the telephone and wait for a name to be announced. If you wish to cancel your request, please press the pound or hash key. First question comes from the line of Adrian Butt of Citi. Please go ahead.
Good morning, Michael and team. Michael, I was interested to pick up your comments about potential acquisitions. I think there's a comment in the release that you made offers on a number of properties which hasn't been included previously. Could you talk about any shift in your thinking on the strategy for the trust, or whether that's reflecting a change in market conditions and perhaps the type of properties that you're looking at and how close you were on pricing, please?
Okay. I'll talk to those points, Adrian. I don't think it's a shift in strategy. I think we certainly look for properties. I guess by the nature of BWP, you tend to be an owner of property for a long period of time. So we're looking for property that we think can create property over the cycle of the property, as opposed to, going with the trend on the external cycle, because we tend to take a view that we will own a property for more than one cycle. So that hasn't changed. Obviously, the market remains very tight in terms of cap rates. I think it's really been more the quality of properties that have become available, and we have seen a few large format retail properties come on the market which had a Bunnings in them, and also some other large format retail, and so they were attractive to us. One, because they've got a Bunnings in them, but they were quite defensive in terms of their other tenants. So we thought over the longer term, even if you have to pay a very tight cap rate for them, it sort of, supported our thinking on what type of asset works best for the trust. So to answer your question, I don't think it's a change of strategy, and I guess the external environment hasn't changed, but some of the assets coming on the market certainly had. In terms of, we were very close on a couple of the properties, and I think we were certainly bidding as close as we could to the market. But if someone thinks it's ultimately, if it's worth more than you do, I guess that's what happens. But I would say we were right there with the market on those properties.
Thank you. That's good color. Can I just check, please, has there been any shift in your return hurdles, or are they stable? And if you were to execute on an acquisition, how you would look to fund that, please? I guess cost of capital is coming down as interest rates and other returns come down. So our cost of capital adjusts with that. We haven't suddenly changed our methodology. It's more been driven by the market. Sorry, Adrian, what was the second part of that question? Second part was around funding. How would you fund acquisitions if you were to proceed?
Yeah, sure. Look, our preference is to put in place, particularly when you're buying things at fairly tight cap rates, is to put in place a bond and a longer term duration bond, and with fixed rate at about the same time. So certainly, if we'd acquired any of those assets that we've been looking at, that was our intention to do that. And certainly, you can't always say that market's going to be open, but certainly in a period of time when we've been active, the market for doing that has been open. I think it's just obviously it's preferable. I think where you match assets and liabilities if it makes sense to, and it certainly would have done if any of those acquisitions had been successful.
Thank you. That's helpful. I'll leave it there.
Thanks, Andrew.
Thank you for the questions. Next question will come from Luke Pirang from Jarden. Please ask your question.
Yes, good morning, Michael, Andrew, David. Two questions, if I may. First of all, for the alternative use in Cairns, Belmont, and Midland, can you give an indication for those short-term leases where rents are roughly compared to what you would consider market commercial rents?
Sure, Luke. Andrew, why don't you answer that question?
Yeah, sure, Luke. Look, I think across all three assets, we feel that the rents are at about market. For the Cairns property, it was a 5-year lease term that we're going to enter into. Similarly at Midland, and Michael's mentioned to you that the Belmont North short-term lease is up to 2 years with the New South Wales Health Department for their mass vaccination centre.
Great. And then, you clearly did well with Croydon and Port Melbourne developments. Is there anything in the pipeline for this year, next year, in terms of smaller upgrades?
Yeah, Luke. We've got one which was just approved by the board yesterday, which is in Lismore in New South Wales, and we are talking to Bunnings about a couple of others at the moment. So they're not sort of set in concrete at this point in time, but certainly there are potentially some more in the pipeline.
And Coburg as well, Michael.
Oh, yeah. Yeah.
Right. Thank you. Well, what's the capex on those two that are approved, Lismore and Coburg?
North of 13 million and Coburg's about 3 million.
Thank you.
Thank you for the questions. Once again, if you'd like to ask a question, please press *1 and wait for your name to be announced. We have the next questions from the line of Richard Jones of JP Morgan. Please go ahead.
Good morning, Michael. Just what's the return on those capex projects, and is that just a negotiated outcome?
Yes, it is, Richard. It sort of varies by property. And so, are you talking about the actual return on the capex, or the sort of IRR of the project return? In terms of IRRs, they're probably, I'm just trying to remember, but it'd sort of be in the 7 to 8% IRR range for those sort of upgrades.
And what is 5 to 6 yield are then?
Beg your pardon? The
5 to 6% yield on cost?
I think Coburg, Andrew, was about
5.5.
Yeah, and Lismore's a bit less than that, and that was more driven just by the overall package on that property.
Can you elaborate a little bit more on it?
Yeah.
Sorry, Michael.
What's that, Richard?
Can you elaborate a little bit more on that? Sorry.
Oh, well, Lismore's 4% on the capex.
Okay, and then you just work it through why that's something worth doing.
Yeah, well, lease extension. We think in that location it makes good sense to for Bunnings to be there for longer and to improve their offer. And I guess we need to consider the rent on the property before and afterwards, and what that means over the longer term. So on balance, that all made sense to us, in terms from a project point of view, to do it on that basis.
Okay, just one more question, just following up from Adrian's question. Just in terms of the assets that you bid on, were they standalone Bunnings assets?
No, they had other large format retail on them as well.
Thanks, Michael.
Thanks, Richard.
Thank you for the question. Our next question comes from the line of Tom Boudoir of UBS. Please ask your question.
Good morning, Michael. Just one quick one from me. I just wanted to sort of question the sort of use of capital to deploy the distribution, given that the market rent reviews are sort of below flat and a significant portion of the CPI was very low. What your sort of thoughts are around that in the longer term?
Yeah, thanks for the question, Tom. Look, the way, I mean, as you're aware, we pay out 100% distribution. So, you know, when you get, I mean, putting aside the sort of underlying trend in the portfolio, but when you know, you do get a vacancy, if it's a Bunnings warehouse, it's, you know, normally a couple of $1 million of rent that suddenly disappears, or you decide to sell a property. So, you know, you get variability around that DPU, and because we've sort of had a few years in the portfolio where there have been a few vacancies which we've been working through, we have taken the view, and I guess part of our strategy on some of those properties is where it makes sense or where it makes the most sense to. We have been selling some property which has created some capital profits. So we have taken the view that, you know, because of, you know, what is causing that variability in distributable income, that we would keep a distribution at least stable. Obviously, our preference is to grow it, and we would use some of the capital profit that, you know, has come from the same, you know, the same properties that are causing that variability to maintain that. I mean, in terms of going forward, I mean, the way we tend to look at everything, you know, we're always, I guess, forecasting or at least 5 years forward on a sort of rolling basis. So, you know, without providing any guarantees or any, you know, firm views of what happens in the future, I guess, you know, while we can see that it makes sense to continue to, you know, pay out a bit of capital profit when we think we need to, you know, we're comfortable continuing to do that.
Okay, thanks for that.
Questions. Our next question comes from Stuart Hardwich of Phoenix Portfolios.
Good morning, Michael. Just turning back to slide 15, if I may, the cap rate slide. You know, you're consistently showing a portfolio cap rate above the transactional evidence, and I appreciate that in a lot of those transactional evidence, it relates to new Bunnings stores, so with a material longer WALE, but not all of them are in that category. Should we allocate the difference to effectively the cost that you're going to incur at lease termination? I guess the second part of that question is, to what extent are you, to the extent that you are able to go through these releasing strategies, what type of income are you getting in comparison to the final payments from the Bunnings tenancies, and how much are you having to spend in order to get that income?
Sure. Okay. Andrew, do you want to have first crack at answering those questions?
Yeah, sure. And look, there's many variables that go into working out the value of these properties. It's not just the covenant, it's the location, whether it's in a metropolitan area or whether it's in a regional area, and, you know, whether the property's got good accessibility, the alternate uses that the property could be turned to, should Bunnings vacate. That's something really important to look at as well. I hope that answers the first part of your question. And sorry, just to finalise there too, there are properties in our portfolio that are not leased to Bunnings, and they're not standalone Bunnings warehouse transactions, whereas all the dots on this page are all standalone Bunnings warehouse transactions.
Andrew, just before you move off that point, I mean, we've certainly got property in the portfolio at cap rates not far off the current cap rates as well.
Look, that's correct, and the sharpest cap rate we've got in the portfolio is actually at 4% for the Port Melbourne asset, which is a new 10-year lease to Bunnings. So we've marked that pretty much to market there. In relation to your releasing questions, generally we find that the rents are higher than what Bunnings is currently paying, and part of the reason for that is we've carved up the building into multiple tenancies and leased them out to large format retailers and other occupiers that take a smaller area, but the rates per square metre are higher than what Bunnings is paying over the property. It varies from location to location, depending on the demand and the actual use that you put into the building post Bunnings vacating. And the CapEx also varies from property to property, depending on the use.
Okay, yeah. Can you give me some kind of idea in terms of, so if you're getting extra income, how much are we spending to get that extra income in terms of the carve-up costs?
So look, at that varies. I'll give you some indication on carve-up costs as a general rule of thumb. I'd be using $750 to $1,000 per square metre on the area. And that depends on whether it's large format retail or what kind of large format retail. In terms of the rental income, it really depends on each of the retailers.
Okay, thank you.
Thank you for the questions. Next one comes on the line of Lauren Erie from Morgan Stanley. Please ask your question.
Yeah, hi Michael. Just a couple from me. On the CPI, the rent reviews that you got this year, it looks quite low at 0.5%. Could you just talk about why that number is very low?
Sure. Andrew, do you want to talk to that?
Yeah, I can. Sure. Look, in the I think it was in the September quarter of 2020, we actually had negative CPI on a number of our properties in the portfolio, and so there was like I don't know, it was about up to 7 or 8 that actually had like 0.3 negative reviews put through. So that's had quite a bit of an impact. So that 0.5% is the average of every CPI that we have done.
And so, Lauren, the way to think about that is, I mean, obviously the actual time when the CPI is measured varies by lease during the year. So, that's why you get a number that doesn't necessarily correlate with the market or the Reserve Bank derived numbers.
Yeah. Does that kind of imply that I guess there should be a bit of a bounce back in the CPI rent review that you get this year if we're cycling some of those really weak numbers?
Yeah, potentially. Yep. So I think we've just had 3.8% headline rate. That'll flow through to a number of the CPI reviews coming up.
Okay, cool. And just Michael, just wanting to clarify, some of the comments you made around the guidance, and the timing of potential vacancies versus paying out capital profits. Is there a scenario where you don't need to pay out capital profits this year, or is it simply more around the quantum of capital profits that you have to distribute?
As we currently speak, and obviously this does vary throughout the year, and it can vary by lots of different factors. But for this year, we would, at the moment, we would expect to pay out some capital profit, just in terms of where we're at in terms of repositionings, etc.
Okay, cool. And just last one from me, can you remind us of what percentage of the portfolio you need to lease to Bunnings versus where that percentage is today?
What we've historically said is the preference is to have at least 80% of the portfolio leased to Bunnings, and as at the 30th of June, David, can you just remind me of that number?
86%, Michael.
Yeah, that's right.
Okay, so if you were to go and purchase, some large format retail, would you need to rethink that portfolio weighting strategy?
Possibly, and I guess if we were to do that, we would obviously be signalling that and why. It certainly wouldn't be something that we would not, our intention, if we were to change that, it would be for good reason, I think, or unless we took a view that there was a non-Bunnings tenant, which had a similar risk return profile and a similar level of covenant. I guess you would take a similar view to what you take on Bunnings. So, it's certainly not currently our intention to change that, but equally, it's a number that was put in place historically, and if it makes good sense to change it at some point in the future, you would change it, because you don't want to be sort of held to a number that sort of no longer be relevant. But what I would say is it's still relevant at the moment.
Okay, great. Thank you. Yeah, that's good.
Thanks.
Thank you for the question. There are no further questions at this time. I'd like to hand over the call back to the management for closing. Thank you.
Okay, thank you. Thanks everybody for participating in the call, and if you have any follow-up questions, obviously feel free to get in touch, and I hope the rest of the reporting season goes well for everybody. So we'll end the call there, and thanks again for participating.
That concludes our conference for today. Thank you for participating. You may now disconnect.